welcome to this weekly update. I'm Julia Lee, an equity strategist at Bell Direct. And really, it has been expectations around lower interest rates, which has been powering along the market, with the US stock market hitting all-time record highs this week and the Australian share market not far off all-time record highs. In fact, the market has gone this week from pricing in a 3% chance of a 50 basis point cut over in the US to an 18% chance of a 50 basis point cut. So let's start off by having a look at some of the quants, and Credit Suisse having a look at the quantitative environment, saying that what we are seeing is low growth and high valuations. In fact, just having a look at the ASX 200 industrials, excluding the financials, the 12-month forward PE is currently at 22.4 times, which represents an +3 standard deviation level. In terms of valuation opportunities, they've looked at things like PE ratio, price to book ratios, dividend yields, as well as enterprise value to EBITDA. They say that what's attractive is the energy sector, the material sector, metals and minings, diversified financials, and banks. But if you have a look at it from a quality perspective, which looks at 12-month forward return on equities and forward EBIT margins, they say the most attractive sectors are the industrial, consumer discretionary, and the consumer staples sector. Counteracting that is valuations, in particular consumer staples, where they say the PE ratio, the price to book value, dividend yield are all above 2 standard deviation levels. They've then had a look at the upcoming reporting season and the downgraded stocks in confession season. And they say that the downgraded basket of stocks on an equal weighted basis has produced a 1-month return of -3.9%, or relative to the index, a -6.3% performance. The downgraded stocks include Adelaide Brighton, Blackmores, BlueScope Steel, Caltex, Challenger Financial, Domain, Eclipse, Flight Centre, Link, Reliance Worldwide, St Barbara Mines, Speedcast, Star, Seven West Media, Vocus, as well as Wagners. Moving on from Credit Suisse to Morgan Stanley, and staying with asset allocation, at this time having a look at the Morgan Stanley cross-asset playbook. They've moved to underweight equities for the first time since 2014, when their cross-asset playbook was initiated. In fact, their strategic allocation is the most defensive it has ever been. They've seen deterioration in business sentiment and growth data, as well as a switch in their cycle model to downturn, which happened at the end of April. They see poor upside to return targets. So they are underweight equities, where they are underweight by 4%, underweight credit by 3%, they're equal weight government bonds, where they're over by 2%, and overweight cash, where they are overweight by 5%. In equities, the US is their least preferred market, followed by emerging markets. Their most preferred is Japan, as well as Europe. Moving from asset allocation into sectors, and UBS looking at the supermarket space with their grocery tracker. They say they've seen a fall in promotional intensity, and that means rational pricing is a positive for sector sales margins as well as valuations in this space. They remain positive on grocery as further signs of inflation are evident, and they are positive on Woolworths and Metcash, with Metcash being their most favoured. They're less negative on Coles, but it is their least preferred option in this space. Looking at Macquarie and iron ore has been on a fantastic run. That's because we've come through the biggest iron ore deficit since 2001. Macquarie, though, say that peak supply is now behind us and the disruption is behind us. The physical market, they expect, will remain tight for the rest of the year. The biggest risk, though, is a slowdown in steel demand. So watch steel demand as an indicator for iron ore prices. Moving on to stock-specific things, and Morgan's looking at their model portfolios. In their balanced portfolio, they've topped up Oil Search. They say Oil Search is trading more than 30% below fair value due to macro concerns, as well as recent political uncertainty in Papua New Guinea. In their growth portfolio, they're adding Telstra. They're also topping up Oil Search, but trimming Aristocrat Leisure and People Infrastructure. Interestingly, they say that Telstra has attributes better suited to the balanced portfolio, but they've added it to growth because they think the share price can rally. They've trimmed Aristocrat Leisure as well as People Infrastructure due to the rising price and hence the heavier weights that they're carrying in the portfolio. So all in all, the share market has looked pretty good this week with the US stock market reaching all-time record highs. The Australian share market also close to all-time record highs, but it is the expectations around falling interest rates which is driving this. In fact, if we have a look at return expectations, these are relatively low and valuations are still relatively high. I'm Julia Lee, an equity strategist at Bell Direct. Hope to see you next week.